Welcome to the 7th installment in Trading Strategy Guide's Trading Education Series. We trade currencies in pairs. I'm going to show you what that means and why we do it. Stick around. Hi, this is Tim from TradingStrategyGuides.com. Thanks for coming back for this installment of our Trading Education Series. Like last week, today's video will be short. I'm going to be explaining some fairly basic stuff. We will be getting a lot deeper into these topics, but I want to be sure everyone is on the same page and understands the terminology before we get into the more extensive explanations. Back in the olden days, like back in the 80s, when you wanted to trade currencies, you had to start with your own currency. So let's say for the sake of this example that you're from the United States of America and all your money was in US dollars. If you, for this example, wanted to take advantage of a discrepancy you noticed between the Great British Pound Sterling and the Japanese yen, and you expected the yen to rise against the pound, you would have to start by selling your US dollars and buying yen to start. Then at the end of the expected move, you would exchange the yen for pounds to get the advantage of the move, and then convert the pounds back to US dollars. Here's the problem. What if there was a huge move up in the US dollar against the pound sterling during the course of this series of transactions? That's right, the advantage you gained in trading the yen against the pound could easily have been negated by the US dollar move. It was a complex mess. Enter the currency pairs. Forex trading is done with currency pairs. As I've mentioned in prior videos, you can trade just about any fiat currency in the world against just about any other fiat currency. You just have to find a Forex broker that offers that particular currency pair. For the sake of simplicity, we'll only discuss the major crosses or pairs right now. Those would be the pairs that include these currencies: the USD or US dollar, the EUR or Euro, the GBP or Great British Pound, also known as cable and sterling and all sorts of other things, JPY, Japanese yen, CHF, the Swiss franc, CAD, the Canadian dollar, AUD, the Australian dollar, and NZD, the New Zealand dollar. Now, these are the typical pairs that are made up from these 8 currencies. I'm not going to name all of these. You can look at them yourself. That's 28 different pairs. The left-hand currency in each of these pairs is called the base currency. The right-hand currency is called the quote currency. For example, the very first pair listed is the Australian dollar-Canadian dollar currency pair. Yes, I put these in alphabetical order because I'm just a little bit OCD like that. In this case, the Australian dollar, or the Aussie, as it is affectionately known, is the base currency, and the Canadian dollar, or loonie, is the quote currency. But you don't have to remember those fancy words. If you want to know what the price on the chart you're looking at means, just say the pair this way in your mind. This is the Aussie in terms of the loonie. In other words, this is how many Canadian dollars it takes to equal 1 Australian dollar. You can see the price of the Aussie loonie currency pair at the time I shot this image was 0.9160. Canadian dollars for each 1 Aussie. So the Aussie is worth just a little bit more than the Canadian dollar. So you can see the advantage here. You can have your brokerage account in any currency you want and trade any pair you want with essentially a single transaction. Well, it will be a matching pair of transactions, a buy and a sell, but not necessarily in that order. All right, I know that's a bit confusing. Allow me to explain. Let's go back to our original example, the Great British Pound, Japanese yen. Remember, we were expecting the yen to rise against the pound. So the currency pair for these currencies is the GBP/JPY, which is the pound in terms of yen. If you buy a currency pair, you are expecting the base currency to go up and the quote currency to go down. But I told you you didn't have to remember those terms, so look at it this way. When you buy a currency pair, you're expecting the first currency in the pair, in this case the GBP, to go up with respect to the second currency, or the JPY. If you sell the pair, you are expecting the first currency, the GBP, to go down with respect to the second currency. So if you're expecting the yen to go up and the pound sterling to go down, what do you want to do? Well, you want to sell the currency pair. Then after the move is over, you buy it back and bank your profits. And that's what I mean by selling and then buying it back. I know it seems weird to sell something you don't have yet, but that's how it's done. What you're doing when you sell the GBP/JPY pair is that you are simultaneously buying yen and selling pounds. When you buy the pair back, you are simultaneously selling the yen and buying the pounds. And that's how currency pairs work. It may seem a bit confusing if you haven't done all this before, but as we get further into this training, it will make a whole lot more sense. That wraps it up for this video. Don't miss our next installment in the Trading Education series next Wednesday, where we'll discuss what is a pip. And of course, be sure to catch my Trading Picks videos on Friday and Monday of every week. And also be sure to subscribe and hit the bell so you'll be notified when these videos come out. Have a great Wednesday, and I'll see you with a new Trading Pick on Friday.